Okay, so I know that these risk management strategies tend to throw a lot of people off, but there's a couple that I think that you really should know. This is one of them. It's the covered call. Covered call. Okay, so first off, just think about what your position is. You are long the stock, and then you are short the call option. So if the stock gets, if you get exercised on this call option, you're covered because you can deliver the stock. That's where it comes from. So let's just think about our position, and it can answer the questions here. What is the value at expiration? Well, we own the stock, so that's whatever the stock is worth at expiration, and we've sold the call option, whatever the call option is at expiration. It's either 0 or there's an intrinsic value. So there's the value at expiration. Now, let's just talk about things like profit at expiration. So the profit, this is going to be the value minus the cost. What was the cost of my position? Well, the cost is made up of what you paid for the stock and then minus what you received for the premium on the sale of the option. So there it is. Here's my profit. Okay? So now let's look at a diagram for the remaining items here. So we'll put this up here. So here's our diagram. Here's the underlying stock price, and let's see here. This is the payoff to being long a stock. This is the initial stock price, S0, gains and losses. Okay, so this is just owning the stock by itself. Now, if I sell a call option, remember a call option would go up. If I sell it, it's going to be the opposite. Let's assume that the strike and the stock price are the same. So this is what we will see, something like this, minus C. Okay, so we'll put this in here as the strike price. So the initial stock price and strike price are the same. So what does this tell us? It tells us if the stock price moves up above here, somebody's going to call it away. So there's a cap already. This upside, gone. Forget it. What if the stock starts moving down? Well, nobody's going to call the shares, exercise their option. So we're a loser. We start to lose money here. Okay, so now this thick line here, this becomes the payoff to the covered call. Covered call has a break even right here. Okay, what do you think this break even is? The break even is your cost. What did it cost you? I paid for the stock, S0, and I received the premium, C0. That's my break-even price. What's the maximum loss? The maximum loss, that's your cost. Again, it's the same. So I don't have to think about this. I already know how to calculate here. What's the maximum gain? The maximum gain here now is going to be, what do I receive? So let's hear the maximum gain or profit. Maximum profit, well, I get the strike price, and then let's just take off the cost. That's the stock and the premium that I received. Sometimes, and like I said, if the strike and the stock are the same value, you will see the maximum profit being equal to just the premium that you receive. That's it. So covered calls are an income strategy. There's no upside, well, really limited, and they only give you a little bit of downside protection. Okay? The idea is you want the stock just to remain where it is and collect that income. Okay, so now we'll move on to a numerical example.